What a morning, what an overnight. And with the Huawei licenses, at least the reports of those licenses, tech is at the center of this.
Yeah, I mean, who knows what to expect? The reality TV president is keeping us hanging. It's all about him. But it certainly wouldn't surprise me to see a concession here. And that the market is right to see that.
Because the White House doesn't want to see this escalate going into...
Usually when there's a private meeting between the president and somebody on the other side, there's some personal exchange and concession. So it wouldn't surprise me. But the bigger issue, and we see this with Fitbit and others and Apple, it's just so hard to run a business in this environment. And so the sooner we get to some sort of situation that's stable for a while, the better for business.
Neil, that sort of raises the question of what is normalcy now to purchasing managers, corporate treasurers, human resource, people who have to hire, fire in companies of any size. What's normal now? What's normal enough to let them plan?
I think it depends on the size and scale of an organization in technology. What you saw with Fitbit's announcement is being a little bit smaller in the amount and the number of products you create in China will require you to move those manufacturing facilities offshore, perhaps to Vietnam and Philippines, so it doesn't necessarily solve the administration's point. For larger companies, you can continue to build and manufacture in China, except a lot of those goods are going to have to be deployed and sold in Europe, and you will need to move manufacturing elsewhere. I think the new normal, Carl, is that depending on your scale, you're going to have to realize that China is going to be an up and down market. You're going to have to manage how you build your teams in China and how you put your manufacturing facilities throughout the world.
So, Neil, how does this change how you invest?
For us, venture capital, contrary to popular belief, is not about putting significant amount of capital in companies that are really hot right now. A year ago, we invested in a team of a stealth company that was basically all U.S. armed special forces who were very much tech wonks building software. That particular company, we believe, is in a competitive position to succeed because if you're going to sell this software, it happens to be drone and AI software, into Defense Department or into large enterprises in the United States, it's pretty important that software is no longer built offshore, specifically in China. So I think from an investment standpoint, that's one thing we are doing. We also specifically do not raise any capital for our fund from those regions. We are exclusively U.S.-based endowment, nonprofits, foundations. So as investors, you can make hard choices to raise capital from the best and most elite investors who happen to be in the United States.
Henry, I want to go back to Fitbit being this latest company that's shifting its supply chain, its manufacturing operations out of China, because we've seen, and mind you, it's been kind of a slow trickle, but we've seen companies that are making these moves. And once a company makes a move to make those investments somewhere else, build out the production capability somewhere else, it's very hard to reverse that, which begs the question, if tariffs stay in place on the existing imports, or you even see more tariffs go into place, and they stay in place for a longer period of time, and more companies do that, the argument could be made that those tariffs are working because it is reimagining supply chains, and at some point it's going to stop being such a negative.
Well, I mean, working if the goal is to punish China. Working because it's better for U.S. business and U.S. consumers, that it certainly doesn't seem like it from my perspective.
Okay. So then, I guess it begs the question, and we've had this conversation on our air as well. If not hardware, if not tech products that need to be manufactured, where should investors be putting their money right now? Software, enterprise?
Leave that to Neil.
I mean, Goldman does come out today, Neil, and say that enterprise spending is going to be challenged. Just survey work backed up by Morgan Stanley in a separate report yesterday. I mean, downgrades of Cisco. Are you worried that hardware is in trouble?
So we do think that hardware can be an up and down market. We had a portfolio company, for instance, that, this is not a new story. A year and a half ago when ZTE struggled and ZTE outsourced manufacturing, their partners struggled, and that included one of our portfolio companies. So 90% of our portfolio tends to be in software, and we believe that even on the enterprise side, in the near term, software may struggle as the economy turns. But generally speaking, you can build these companies quickly. You can build them in the cloud. They're highly relevant to security, you can build software and have it scale much faster than hardware. So we tend to focus in those areas.
Speaking of software, Amazon's top spokesperson taking a swipe at the president while on stage at GeekWire in Seattle yesterday. Jay Carney, who served as Obama's press secretary, said he doesn't feel like the White House is working in the best interest of the